You're listening to RIAcast, a podcast of the Southwest Florida Real Estate Investment Association. RIAcast brings together a variety of real estate entrepreneurs from all over the world to share tips and ideas. The core purpose of the Southwest Florida RIA is to help members become more profitable and successful through networking, education, and empowerment. Here are your hosts, Jeff Tamarello and Michael Lyons.
Well, welcome everybody. This is my name is Mike Lyons, one of the directors of the Southwest Florida RIA. I am joined by the other director of the Southwest Florida RIA, Jeff Tamarello, and our speaker at this next meeting we have, our evening meeting, is Mario Datillo. Mario, welcome. How are you?
Hey, thanks for having me. I'm excited to be back at the Southwest Florida RIA again, and appreciate you guys inviting me to speak again. It's always an awesome group to be with.
No, we appreciate that. Yeah, we thought it'd be good to touch base with you prior, maybe put out some information, not to give your whole presentation away, but to provide some bullet points of what you'll discuss, so people know prior, what we're going to talk about. But so, if you don't mind, tell us a little about yourself, your experience, and what you've seen and done so far, and we'll go from there.
Well, so I was born in 1984.
What's your social security, your date of birth?
I got that right here. So anyways, been in real estate investing for 17 years, something like that. Done a lot of different things. Started out in the brokerage business up in Minnesota, and then in 2008 market crash, was helping clients buy and sell stuff. And my dad was in construction his whole life, like commercial construction, and he was a builder and everything. And so I went to him and said, hey, look, let's team up. You do the construction, I'll do acquisition and disposition. And so we started investing back in, call it 2008, and found Southwest Florida through a friend, started buying some stuff down here as well. And that was all single family. And then in 2013, 14, started buying mobile home parks and self-storage, on a little bit of RV parks as well. Have an investment company, have a brokerage, have an education company that coaches people on buying mobile home parks, have a dealership, all these businesses kind of all servicing that manufactured housing industry.
That makes sense. That's great. That was a lot. We could probably stop it here if you guys want. That was pretty good. So it's safe to say you're not in one that does a lot of flipping. It's buy and hold, long-term investment stuff. That's safe to say, the approach?
Yeah, I came from wholesaling and flipping for many years, from like 2008 to 2013, 14 on the single family side, and kind of want to get out of the trading business and wanted to get into more of a buy and hold wealth creation. Actually, Jeff, truth be told, I remember the day that you and I were talking. It was on the second story of that golf course building. I can't remember what that was. That building. Yep, the Edison. We're talking, and Jeff said something like, well, think about this. How many of the most wealthy real estate investors do you know flip homes? I started thinking about it because we were talking about flipping and versus long-term hold. And I said, not many. Everybody I know is in the landlord game. They all own stuff long-term, the wealthiest of them. Yeah. And that was like a light switch flipped, because we were trying to figure out what we wanted to do, whether we want to keep flipping or we want to get into something else. And that's when I went, okay, I want to buy and hold. And then I started thinking about, what do I want to buy and hold now? And single family just wasn't interesting to me. So I wanted to get into some sort of commercial property. So Jeff, thank you.
All credit due, Jeff.
So every bit of success, all you for you.
That's right.
I know.
Yeah.
I know.
You're welcome, Mario, as we say. You're welcome. No.
Yeah.
No, you know what though? It's we talked about this. We were just on with Brett Foschi. We were just talking to him.
Yeah.
And it's amazing the amount of like mentorship you get when you are younger and in the game, if you just listen to people.
For sure. Just shut up and listen.
Yeah.
Don't try and be the smart guy in the room, right?
We've always been that young guy where we hear the older guy that's had experience, and we know better.
Yes.
No, we don't. They have been there, done that, and I think going through the process yourself, and you kind of have to go through your own little learning curve on things and go, wow, they were right. And
absolutely.
But the whole buy and hold, even going back to that, the buy and hold guys, and I deal with a lot of that and buy and hold myself, to build wealth. and the wealthiest investors I deal with, none of them flip. And again, not knocking flipping by any means.
Yeah.
I mean, people that do it and do it well and make good money at it. But the real wealthy will they'll hold real estate for a long time.
Well, and when
Flipping
you
makes
look
you
at-
money. Buying and holding makes you wealthy.
Yep.
Yeah.
It's
When
true.
you look at what we're doing with the money supply, we're in what's called financial repression. I mean, the way they're printing money, and it benefits hard assets, because the money supply is going
For
up and up and up, and debt's going up and up and up. And, I crack up, those 2000, even if you held a 2005 purchase to this point, you're all right.
Yeah.
So,
Yeah.
and then that was a mania. That was a historical mania. That wasn't
your
even a
mistake
boom.
is corrected through time.
Yeah.
Yeah. Yep.
Well, one thing I found too is if you're buying and holding, you buy right and it's cash flowing, whether it be a mobile home park, a storage unit, a single family home. Time, as long as you're holding the asset, you're buying, I'm sure paying down the debt if you have debt on it. 15 years, 20 years in most cases, it's paid for and it's just cash flowing. I mean, you got
Exactly.
some reserves, but that's a great way to build wealth, man. Just
It's a
huge.
lot less speculative than other strategies. Not likely going to get hurt buying something that cash flows, especially if the market comes down, tanks. You're really not worried about the valuation as long as your debt has a long enough runway and all that. You can be in pretty good shape.
Agreed.
Or you have no debt.
Or you have no debt. Yes.
Yeah.
And the cash buying guys, investors that own, that own property, they don't care about how much it's worth up or down. I mean, they don't like the insurance or tax bill that might come in the, but
Sure.
other than that, they're worried about cash flow, worried about money coming in. That's it. So a property that was worth, that they bought for 100, that's worth 300 now, they don't really care. They're more worried about the cash each month. So that's huge. But now we're in a kind of a weird market now. Today's market's kind of weird. It's really weird. What are the market conditions now? How's that affecting your approach to buying stuff?
Well, I'm excited about it, to be honest, because exactly what you're talking about. I mean, the properties I've bought are cash flowing assets, got plenty of runway on the debt, not concerned about that. And we're in buy mode. What I've found is that sellers who need to sell are selling right now. Sellers who don't need to sell aren't selling right now. So there's more motivation in the market than I've seen in a long time. It was funny. I spoke at the IMN conference last year. Jeff, you and I talked about that. And I was on a panel and it was myself and one other smaller investor, right? And then we had three other institutional investors, very large operators on the panel. Excuse me. And it was a weird dynamic because they were saying they couldn't buy anything at the time, where him and I are like, we haven't been able to buy anything for the last couple of years. And now we're finally getting real deals going again. And it's just a very different strategy.
It was because of them.
Yeah,
Mario, it was because of the other guys on the stage is why you couldn't buy anything.
Exactly. And exactly. And the way that they were structured, they aren't able to buy. They were having a hard time buying things because all the stuff that was coming to market was like motivated kind of value added deals where they just wanted to buy the clean, stabilized stuff. And on top of that, the way that just kind of talking to them offline, the way that they were set up with their credit lines and how they're buying things is very contingent on floating debt within their credit lines, and their rates had went up. And so being able to go and buy things right now didn't make sense. Where for us, we're doing all this creative stuff with seller financing and, so we're just ramping up and they're kind of like waiting for the market to come back. So it was just kind of an eye opener for me to hear that. I was like, wait a minute, you guys can't buy anything right now. So we're having fun. We're buying things again.
That's awesome. That's awesome.
Yeah.
Well, we don't want to give away your presentation by any means, but we do want, some bullet points that you might want to share. For example, you got a newbie looking to buy an investment property. What kind of advice, again, this is a very loaded question, but however you want to take it and share, please do. But buying either, passive income or being very involved in the asset, like what kind of advice would you give?
Yeah. So I'll give you the quick snapshot. If I've got a really strong income coming in, I'm making a lot of money, I should probably consider before I stop doing that to go buy real estate, what's going to happen to my income stream, right? So I've got a friend of mine just makes an insane amount of money wholesaling and, just remotely, no employees, all that, just makes a ton of money. And he's like, yeah, I think I'm going to go buy apartment buildings. I'm like, okay, think about that. You're running a business that's kicking off 7 figures a year, and you're going to stop and go buy apartment buildings and learn that entire business. And so he reconsidered, and I'm like, you need to stop and go partner with somebody who's running it as a business that has the team, the systems, the experience, education, whatever, to effectively operate those buildings. You should own those apartment buildings or whatever property type it is, but you shouldn't stop the income stream to go start another business. Make the money. And so I would say that you need to understand your current situation. Now, if you're looking to create wealth through real estate, that's probably a different situation where you're looking to start a business buying real estate. You can be an investor and active, but there's the difference between being a passive investor and an active investor. If you're an active investor, you're really running a business, and so it's going to take time. And I think people underestimate the amount of effort that it takes to effectively operate real estate. There's no such thing as passive real estate. Even if you've got, triple net leases and things like that, there's still some asset management level responsibilities that you are going to have to deal with. And so I think it's understanding what's your current situation and what are you out to do? Are you out to grow your wealth or become wealthy? And so, it's a matter of recognizing where you're at and where you want to go.
Good. No, it's great. That's great.
Yeah.
Jeff, any thoughts on that, or?
Oh, go ahead.
I had somebody the other day try and tell me that basically triple net investments were passive, and I'm like, you've never been involved in a strip center.
Yeah.
So there's a lot of decisions to make.
There's a lot of
decisions. A lot of decisions you're going to have to make. It's just different decisions, and it shouldn't be a hot water heater ever. They fix those themselves, but you still have a lot of things. And generally, when something breaks in one of those triple net investments, it's a pump station, and it's really expensive.
Yes.
Even though you do get you do get to put that in the triple net side, it's still a decision you got to make. And if you run your cam up, you lose your tenants.
And if your tenant leaves, your leasing process and the approval of that and the build out and everything, there is management involved, and it may not be on a daily basis, but you've got work. And even creating the reports, if you've got partners, there's financial reporting that has to happen. There's involvement. So I think people underestimate the amount of work. And, I know getting into real estate personally, in my mind, I wanted to be the guy that made all the money, right? Well, then keep in mind, my focus was creating wealth. It wasn't taking wealth and just growing it. It was, I wanted to become wealthy through real estate. And so I had a little bit different mindset, but I always looked down on passive investing. And now that I have a business where I bring on a lot of passive investors in my fund, I think of it completely different. I look at it as a partnership, and you've got an active partner and a passive partner, and both have their own roles. And I think not everybody should be an active investor in real estate. Everybody can participate in it, but not everybody should take that active role, and not everybody should take a passive role. So we'll talk about that in the training.
I'd like to jump into that because we're seeing the after effect of that with the multifamily space.
For sure.
You have a lot of people that got on TikTok, YouTube, Facebook, Instagram, all that, and raised a ton of capital and went out and bought multifamily with extremely low interest rates, fueling what they thought was a deal. And they hadn't been an experienced operator to understand that, them rate cap things may be worth paying for.
Yeah.
And you have a couple big portfolios in I think the Dallas-Fort Worth area about to go to foreclosure. And this was a YouTube sensation guy that tried, took a shot, didn't have the experience, and what I can see, really charismatic, raised a lot of capital, but didn't have an experienced operator in there. And even worse is when I see you don't have an experienced operator who then manages the asset with their own created company to kind of capitalize on fees, and a whole lot of limited partners losing money. I mean, it's so important to like you said, to have the experience.
For sure.
Well,
You
gonna
can't
mention
get
too, the
experience
work.
quickly. Go ahead. What?
Well, obviously the work aspect of it, and I'm not saying anyone, I'm not trying to knock anybody. To make money in any capacity, you have to work hard for it. And I think a lot of people might have the concept, and some totally get it the right way, but some think, I'm gonna get real estate, it's pretty easy money, and you can make a lot of money in doing it. And
Yeah.
the only people I've ever met that have done really, really well at it work their tail off to make that money. It's not here's the money, and all right, man, it's a pretty sweet gig. I mean, you have to actively watch it, overlook it, make decisions, change, adjust, meet, go over. I mean, like there's no, here's the money and here we go. You know, there's always, I mean, I've worked with a lot of very wealthy real estate investors, and none of them are, they're very active, involved.
Yeah.
And not even if they're actually getting up each morning and working at an office, but they're checking their investments, they're making decisions, they're looking at stuff. Even if it's not daily, it's weekly at minimum.
Yeah.
And you can't just, I don't make a bunch of money in real estate. It was just horrible at a real estate meeting, at the RIA meeting years ago. And there was a couple people there that said, hey, we just took a course, and our plan is to be retired in about 3 years. And based upon what they're going to do. And I said, I'll see you in 4 years when you're still working. And I, kind of tongue in cheek, but I said it without even thinking. I'm like, there's no way. I mean, there's no, it's a great way to build wealth over a long time. By making very good decisions, being disciplined, and finding out what works, making tweaks as needed as the market adjusts, but being very much involved and on top of it. Even if you're a passive investor, you want to know what's going on with the money you have invested with whomever you're working with. And that's huge. So,
yeah, I would say that even if you've got, a third-party management company managing for you, there's still ownership responsibilities that management company is just not supposed to be doing. You still need to do it. So really the closest way you can get to a passive position in real estate is having an active partner. That's it. Somebody's got to do the work no matter what. It's just doesn't have to be you, but you still have to understand your financials. You got to read the reports. You got to make sure your distributions come in. You've got to ask good questions, but that's about as passive as you can get, because ultimately someone's going to have to take an active role in the deal.
So well, you also have to inspect. I mean, you get what you inspect, not what you expect. And I had a conversation with a friend who's got some capital to put in play, and he basically said he's looking for double-digit passive returns. And I'm like, that's what Bernie Madoff promised.
Yeah.
I'm like, it's really hard to find it. I'm like, if you can find a 7% passive return, please send me the phone number.
Yeah. Well, keep in mind too, the passive return is lower because someone else is active and has to get a portion of that return. Yeah, you want double-digit returns, you are probably going to have an active role in that deal. But if you want to be passive, then you've got to split. There's only so much cash flow that comes through a property, right? The NOI is what it is. Net cash flow is what it is. And it's going to get divvied up based on who's involved. And if you want to be passive, somebody else is going to have to get a piece of that cash flow. So, I've had a few times where passive investors like, oh, that's not a high enough return. I'm like, well, cool. Then if you can find better, you should, but just be careful, because there's probably a reason why you're being offered some significantly higher return with somebody else, doing all the work. So I think it's just, you've got to recognize that you're literally paying to be passive. You're paying somebody else to be passive is what it is. And that's okay. As long as you understand what you're trying to do and you're doing it for that reason.
That makes sense. No. Well, Mario, we're very much looking forward to your presentation. Just for what it's worth. So Mario is speaking at our evening meeting for a real estate meeting in May, which is the third Wednesday of the month, which in this case for May, it's the 15th, May 15th. And we're very much looking forward to having you there. And if someone wanted to get a hold of you, Mario, would you mind giving out that ability, whether it be email, phone, or however you want to approach that?
They can just go to mariodatillo.net.
Okay.
mariodatillo.net. And it's got links to all my companies and kind of the stuff that I'm doing. But I'm really looking forward to doing this. And just so everybody knows, this isn't going to be a pitch on why you should be a passive investor or why you should be an active investor. I think you can kind of tell that I'm agnostic to it. Like I don't believe there's one right or wrong on that. It's who should be doing what. And if you're looking to raise capital, you should definitely be there, because this is going to help you better determine who your investors are and who maybe your joint venture partners are, because there's a difference between all that. And I'll also talk, if you're looking to be a passive investor, I'll help you also understand what to be looking for in the active partner that you're bringing on. So it's going to be a well-rounded event. And we'll get into the weeds a little bit on some securities law things. I'm not an attorney, but I'm going to give you some things that I've learned just from experience that will help you stay out of hot water and kind of point you in the direction to the legal eagles that can give you the legal advice. But I'll make sure.
The SEC does not play.
No,
they do not play.
There is no chill in the SEC.
There's no chill in the SEC, right? So I guess but I think that there's a lot of misunderstandings about it and things like that. And so I'll kind of point you in the right direction on that. And I promise I'm going to bring a ton of value. So be there. If you got to make some changes in your schedule, be there. It's going to be a really solid presentation for anybody who's either in real estate or wants to be in real estate. So
excellent. Mauro, we appreciate your time today and look forward to our meeting.
Yeah, looking forward to it as well. Thanks.
Thanks, guys.
This concludes this edition of RIAcast. Be sure to subscribe to receive our next episode. You can also subscribe at our website, www.swflreia.com. See you at a meeting soon. Please let us know if you have a suggestion for a future episode.